Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of sitting with Chris Vermeulen of the Technical Traders. How you doing today?
I'm good, Daryl. Thanks for having me. Always a pleasure to talk markets with you.
Yes. So a lot of things happening. Let's start at a bigger level. Economy, recession has always been a fear in the recent years and such. And we've had multiple things happening, especially in the U.S. economy. I mean, inflation's still staying sticky. We don't know how much of that is the tariff impact. Economists suspect that the tariffs are impacting inflation and keeping that number sticky. The Fed is saying that they have the tools to keep inflation down. And then we've had recent job numbers where the job numbers were abysmal. And it showed that they had to do huge revisions from hundreds of thousands of jobs down to, I think it was about 73,000 or something total. And then GDP numbers were extremely low in Q1, and that was people suspect that was because people front ran the tariffs, and then the recent GDP numbers were fairly decent, and people suspect that's because they were companies and importers were spending down the inventory that they got from the first quarter, and so. Just want to get a high level view on the economy and what are you looking at there?
Yeah, so I mean, I'm a pure technical trader because I learned a long time ago, fundamentals don't really work when it comes to trading and investing. You can have the best company in the world and the stock price still gets slaughtered. I'm not the one to go for economic data because I believe it's all baloney. You can't trust any numbers that really are out there. And I think even more so, we can't, the more we hear of what's going on and people getting replaced and, labor statistics and all, and the Fed and all this stuff, to me, it's just all phony baloney and everything's, jimmy rigged to, I think, pull the wool over everyone's eyes. So I think we're struggling. I think we've got inflation. I think we've got the economy slowly weakening. I think we have, as you and I are talking now, the markets are still testing near all-time highs, but we have like 3 Magnificent 7 stocks ripping higher, pushing the markets up, making the markets feel like they're really strong. But really behind the scenes, the markets aren't that strong. It's really tough to trust any numbers that come out of the governments and the Fed and all that stuff, in my opinion. So I try not to focus on it because it's not trustworthy data and it's not even accurate. Even if you did trust it, it's not even accurate. I don't think they know, they keep changing how the calculations are made. So a calculation of value now is not the same as what it would have been a while ago in the past because they've changed the formulas. So you can't even go off that stuff. Nobody has a true feeling of how it functions. So I'd be very cautious if you're following the news and what's happening with tariffs and all that. It's the blind leading the blind out there when it comes to following the markets from that perspective.
Yeah, definitely. I could definitely see that for sure. So there's been talk about just being in a stagflationary environment, and stagflation means, sticky inflation, high unemployment, and governments typically spending more than what they have. Do you think we're headed, or are we in a stagflationary environment? Just want to get your take there.
Yeah, I mean, it's not my specialty, but I feel like we are. I think if we're not in one already, that, is secretly happening because everything's covered up with data and fake headlines and all that stuff. I think we're going into one if we're not already in one. So that gives me a very bearish outlook. I think the markets are setting up for a very big financial reset. But in this market condition, it only takes a couple stocks. People only need to push money into 1 or 2 stocks to hold the entire market up and make everything feel like there isn't a problem in the economy and the world. So a lot of people just follow blindly the media. They follow stock pricing, the stock indices like the S&P 500 and Nasdaq, which are moving higher. But really, it's the majority of stocks. We had a big rally recently. In the markets, they moved higher. But if you actually looked at the equal weighted and the majority of stocks, they actually sold off. Yet everybody was bullish and they thought the indexes were going higher, which they were, but it was just because of a couple of stocks. So it's called camouflage, where the market is doing one thing, like it's going higher, but really it's weakening underneath, and the market sucks investors in. And I believe we're setting up for that. But right now, the markets are still, they're still holding up near all-time highs, and you can't fight the trends here. You got to stick with whatever the market is doing. You got to do that, not get caught up in the news.
Yeah, for sure. So there's a saying, follow the chart, don't follow your heart, right? Let's see what the charts are saying. Can we look at the general equities, S&P, and some of the big indices?
Sure, yeah. Let me pull the chart up here. So if we take a look at the S&P 500, you can see we're recently, let me just zoom in a bit here, recently rallying back up. A huge chunk of this has to do with, I think, the Magnificent Seven. If we just look at the mags here, this is the mags ETF. So this is a basket of them. You can see they're pushing up and set to potentially close at all-time highs. And when the mags move up, the whole stock index gets dragged up with it. And of course, it's some of the big players like Nvidia pushing up, testing new all-time highs. We've got Apple. They came out recently talking about they're going to invest billions in the United States to work on manufacturing. And so it had a big pop here, which 2 days back to back. It's funny because if something goes in the news, and this has always been this way, but when a big company gets put in the news and they get talked about, it's really just free marketing for that company, and people naturally just want to go and they want to buy it. Apple moving to the United States, this is just my opinion, I could be totally wrong, but the way I see it is they want to come and spend billions of dollars, move some manufacturing over. To me, it's a huge expense for Apple. It's going to have crazy high probably labor rates and expensive. It's probably going to be more expensive to make their products, which means they have smaller profit margins. And they're trying to get away from China, but they're like completely embedded in China still. So to me, it's a bearish thing, yet the market is pushing it higher. And that's the big difference between, the way I see and trade and invest versus the general public. We're usually going in opposite directions. I see things in a different way, but if we take a look at the Nasdaq, like the QQQ, it's pushing up very similar to the mags. It's testing, potentially set to close at all-time highs on the charts. And of course, it's because of the big stocks. So the trend is trying to hold its ground and potentially move higher. But in the grand scheme of things, the majority of stocks aren't doing very well. And we have that inflation. We have, as you said, kind of potentially stagflation happening, unemployment starting to slow down, or hires, job openings starting to slow down. So, in the grand scheme of things, you got to follow the money, follow the trends. And, if we were to look at the market right now, like the S&P 500, this is my trend signal chart. There's a time when you want to be out of the stock market and benefit from falling pricing or move to another asset class. We recently just had a beautiful move up in the stock market. And really, even though the market's near all-time highs, the technicals, the sentiment, the money flows have actually flipped. And we actually have the start of potentially a downtrend in the market. And so this is what the market does. It gets people all excited. We've had a couple big gaps higher recently on the stock market in the last couple of days that are sucking people in. One of our key tools here, Daryl, is this FOMO indicator that I have, this red indicator. Now, I won't go into details, but it tells us when everyone is piling in, they don't care what price they pay. And when there's a huge level of FOMO, it usually means there's going to be we're getting close to a market kind of top, and it's the general public moving into the market and buying, while institutions are more or less selling and unloading into those people. So that's where I am from the overall market. We're at this tipping point. Are we going to go higher and start another trend and see QE and quantitative easing and the big mags drive this market higher and just defy gravity again, or still? Or is it going to finally roll over? It doesn't really matter. We just need to have a game plan and just be very cautious. I don't think it's the time to stick your head in and take advantage of the markets just yet. I think you need to wait and see. The markets could go sideways for a little while and build a launch pad before going higher.
Mm-hmm. What are those moving averages you have there on the chart?
Yeah, the moving averages, the green one is the 150-day, and then the blue's 50. The pink is the 20-day, and then the 5-day. And they're my favorite moving indicators, moving averages. One of the easiest strategies. Now, there is no simple money-making moving average strategy, but one of my favorite is the light blue and the pink. And more or less, when the blue crosses below the pink, you're usually in a downtrend. When the blue line, the light blue line crosses above the pink line, so the 5 above the 20, you're usually in an uptrend. And that is one of the most active cycles and waves that happens in the market. You need a lot more tools and analysis to identify when a crossover is the real deal or not. But overall, I mean, these moving averages are the best. The 20 and the 5-day are perfect for swing trading, momentum trading, and they give you an idea of what's unfolding. And the interesting thing is, here, if we look at the green line, this is the 150-day moving average. It's still sloping up for the Nasdaq. And you and I have shared this chart before over here, which is the stages of the market. And if this dotted line, the moving average, which is the 150-day moving average, is sloping up and prices generally above it, we're still in a bullish overall environment. But when it starts to flatline or go down and price starts to break through the moving average, then we're potentially in a major topping phase. And that is the key. If we were to strip out the Magnificent Seven and look at the broad market, so this is a balance of 3 ETFs. The RSP, which is an equal weighted S&P 500. So every stock has an equal weighting. There's no heavyweights in there. Then we have the small caps and we have the micro caps. And if we let this chart load, I'll just scroll back a bit more so we can get more data. You can see it's actually turned down. And the stock market as a whole in most people's portfolios had a huge crack to the downside. Now it's bouncing up. You could argue it's, a head and shoulders formation, although this is a very serious break to the downside, or it's just a big double top. And this market could very easily roll over. So the key here is the 150-day moving average is more or less moving down or flatlining. And the majority of stocks aren't participating in this rally. It's just a handful of stocks being driven up. It's the crowded play, Nvidia, Apple, Tesla, all of that, kind of creating this camouflage where the market isn't as strong as people think it is.
Yeah. Thank you for sharing that. And could we look at some of the big names, Nvidia, Meta?
Sure.
I mean, because I think these are multi-trillion-dollar market caps, and they're continuously ripping higher.
Yeah.
And a lot of it is off the news of AI and any type of AI investment or tariff exemption and things of that nature are just pushing these stocks a lot higher. So they're very headline driven right now.
Yeah. So like Nvidia today, if we just zoom in here, it actually poked to a new all-time high. So it is going to get tons of coverage. It's going to be on every headline news. Nvidia hitting new all-time highs again, right? It's going to suck people in. The thing is, we're getting into a little bit of price action here that is actually pretty bearish. We saw a big gap up followed by huge selling. We've got another gap up. It hit to all-time highs. For all we know, by the end of this trading session, it could close sharply lower, and maybe we see more of a top get put in. We've seen this with some other big ones. Look at Microsoft. If we look at Microsoft, massive gap up on earnings, and it's just been hammered and clobbered with selling. And of course, this gap up sucks everyone in to be like, oh, and convince everybody we're in a very, very strong market environment. And while Microsoft may be, because they've got good earnings, in general, the economy, I believe, is slowly stalling and things. And the charts are very bearish. This is pointing to price, coming back down to the 515, 510 area. And that'll pull the markets down with it. So this type of volatility that we're seeing across the board in some of these big mags is usually a sign of a trend coming to an end. Huge gaps and reversals are not a bullish sign when they're gaps to the upside followed by big selling. Tesla, on the other hand, it's building kind of a bit of a launch pad. It's trying to figure out if it's got a launch pad. And it recently had a nice pop, help pushing the markets higher. It doesn't look like much, but that was almost a 4% pop. And what people don't realize is it's just dwarfed from the recent sell-off that we saw. I mean, Tesla fell 56% from pretty much $500 down to like $220. And so there's a lot of volatility in these stocks. There's a lot of risk in this market. And it's really everything feels right now is like headline driven, or it's a magnificent driven stock that's creating these big pops and move. And you and I already looked at Apple a few minutes ago.
Can you go back to Tesla real quick?
Sure. Yeah. Yeah.
I was looking at that move downward. I think that was politically driven. With the fallout with Elon and Trump and such. Yeah.
Yeah, and I think the rally was too. You put Elon and with the president, it's really good for business. And then when they lose their relationship because they're two alphas, then it unwinds. And that's the thing with trading on. These are tradable trends. These were very big trends, but it was a news-driven move. And any news-driven move, whether it's a one-day pop or a multi-month move, usually that news-driven move gets wiped out again. And followers who follow my stuff, we know that you can't trust any of these. These are like free trades. These are free opportunities. You can take advantage of them, but don't think they're going to stick, because once things blow up and unwind and that news works itself out, price will negate all of that usually in the future.
Yeah, for sure. And we're just going to look at Meta really quick.
Sure. Meta's got a strong chart pattern in terms of it's had a very strong pop and it's trading sideways, but look at the volume. Each gap up, huge gaps followed by massive selling. And these are signs of distribution. These are signs. Distribution means institutions, big players are unloading shares into the general public. So these massive gaps to the upside suck in the general public. That creates volume and liquidity. And then the big guys come in with their big portfolios and they just start hammering and selling and doing block orders and dumping shares into the general public. They don't want to crush the price. They just want to keep dumping and selling to as much buying volume as there is from the general public. And it's creating this bullish chart pattern. And it might want to push even higher and suck in more people. But this big selling on huge moves to the upside is usually a very bearish sign. It's, again, all these big magnificent sevens are having these big pops followed by big selling. It's not a good sign. I feel like the sheep of the market, the masses, market participants are paying a premium, and they're going to pay handsomely for it eventually if this market, or when this market pulls back.
Yeah, for sure.
The copper market, of course, is the biggest metal market on the planet, 200 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
And that brings us to, what we focus on here on VRIC Media, metals and mining. So let's go ahead and jump into gold and see where gold is headed and what is the charts looking like.
Yeah, there's some really interesting scenarios unfolding here. I think the best way, Daryl, is to go back, look at 2007, and then we'll jump into this chart, the chart of gold. So if we go back to 2007, the left chart is 2007. The candlestick chart is the S&P 500. And it pushed up to a high, and then it pushed up to a nominal higher high a little while later. Now, this is the weekly chart. And again, 2007. The yellow line is gold. And what's interesting is gold became a top performing asset along with the stock market. It was outperforming the stock market. It was moving up. That is a red flag. That is a major warning sign. In fact, if we look at the cycles and stages, we tend to see precious metals do very well right near a stock market top. And that's what we started to see back in 2007. The interesting thing with this chart too is take a look at what the US dollar index was doing at the time, the green line. It was the most hated currency. It had a huge sell-off. Nobody wanted it. Well, fast forward to where we are today, the S&P 500 hit a nominal new little high right here, just like it kind of broke through, over here. And then it went up, and now we're making this higher high at this moment as we're looking at this. Gold is a top performing or the top performing asset right now. Long term, I think it's outperformed the stock market if you were to buy and hold. And again, if we look at what the dollar is doing right now, of course, everyone hates the dollar. It's had a huge sell off. It's been moving down for quite a while, and nobody wants it. So we're in a very similar scenario when you look at the price charts. And I know a lot of people will say, well, this is nothing like 2008. And it's not. And 2008 was nothing like the tech bubble. But price action and human psychology is the same. They're either buying because they think it's going higher, or they're scared out of their minds and they're selling stuff. That's what creates bull and bear markets, not the event itself. It's the wave of fear. And so let's just zoom back here and look at the 2008. We started to see the stock market, if I can get this to move here, the stock market started to fall after this. And gold, the yellow line, started to rip higher and take off as the stock market fell 20%. Gold shot up almost 40%. And that's kind of where we are right now. I think we're going to see the stock market is trying to put in a top. Gold is pushing up to some new all-time highs on the cusp. Maybe as people are watching this, it's already at all-time highs and has broken out of this pattern I'm about to show you. But I think the stock market is about to sell off in a pretty big way, as long as QE, new program, doesn't kick in and drive things up, and we don't have extra Magnificent Seven manipulation. But stock market's going to sell off. We're probably going to see gold shoot up dramatically. And that brings us back to the daily chart of gold. And my favorite tool for projecting forward price is the Fibonacci extension tool. It tells us, based on this first rally up and the strength of this pullback, where price should go next. And if we were to just look at these two key levels for gold, it is the 3730 area is the first stop. That's called the golden ratio. If we hit the 618 level, we come up and we see some type of pause or hiccup for a bar or a week or so. Then we almost always go up and hit that 100% measured move to about 4,100. So there's a decent move for gold to rally almost 20% to the upside, very similar to what we saw in 2007. And in 2007, the projected upside was about 20%. But typically near major tops and bottoms, you have an exhaustion move, like a blow off top. It hits the target and blows right past it. It doubled that. And we have the same on the downside. When there's a bottom projected, a lot of times there's so much panic selling, it just falls right through the projected bottom and washes out and goes a lot further. Tops and bottoms are volatile, and they can be very, very fast moving and blow past targets. So that's kind of where we are with gold. We are on the cusp of a very nice move, could be 20+%. And the nice thing is, because you're probably going to want to touch on miners, but the miners are breaking out as well. It doesn't matter if it's the gold miners, they've already broken out, which is the leading indicator. Silver miners, I think, are breaking out too. If we take a look at SIL or SILJ, they're breaking out to all-time highs or new multi-month highs, confirming. And typically we see the miners break first in a strong gold environment, and then physical metals move next, meaning gold and silver. So that is my high-level view of gold, and I think gold has potential to rally for a month or two while the stock market starts to top and struggle.
Yeah, for sure. Thank you for sharing that. Could we look at the GLD? That was a recent
Sure.
article that came out from the World Gold Council about record inflows and such, and so I just wanted to look at that.
Yeah, I mean, I haven't heard about the record inflows, but this is typically what happens near a major market top. We saw it in Bitcoin when, I still remember one of the major peaks in Bitcoin. It was on New Year's Eve many years ago, 2018 maybe or something. And I remember being in Florida, and it was mostly seniors where I was, and they're all buying they all got on this crate. They're all buying Bitcoin on their phone with their credit card. And the masses piled in, right? And it's usually right near a major market top, and that was. So when we have record inflows when it comes to any asset class, it doesn't mean it's topped, but it means we're now kind of in bubble phase. It could have a very strong move. You don't know how far it's going to go. You can fully take advantage of it, but no, it's a trade. It's not like, buy and hold, because eventually the bubble will burst and there'll be a reset in price. And gold generally pulls back and sells off with a falling stock market and weakening economy. So I don't see massive volume flow going into GLD. Obviously, it's elevated from what it was in the previous year. But it's a good sign that there's interest in gold. That's actually a bullish sign for this pattern. I think gold's going to move higher. I'm looking at a discretionary trade to get in to play gold with an ETF, just as a trade that could last a couple of weeks or a couple of months. So I really like it here as a play.
Yeah. Thank you for sharing that. And my bad if I got that wrong, audience. I believe I saw that, and when I was reading the report. So looking at the ETFs, I mean, obviously here. We see this pattern. Could this be a bull flag if I'm reading the charts, if I'm looking at the charts right?
For sure. Yeah, this looks 100% like a bull flag pattern. In fact, we zoom out on gold. I usually just flip over to the futures. This is, quick tip is if people are trading something, you're best to trade the actual chart with the actual asset and then trade the ETF, just because the actual asset is more accurate. And then you just trade the ETF to follow suit. So gold has done what you have just said. It's a series of bull flags. We have a big rally up, it flags out for a while. We have another big rally up, it flags out for a while. We've had another big rally, it's flagged out for a while. This is like a very, very strong chart pattern. It's a bull flag pattern. Now, I use Fibonacci extension to give the upside targets, but that happens with all of these moves here. If we were to just, potentially just grab one here, we say, okay, well, here's a low and here's the high and here's this low. We just carry that forward to figure out what the next target is. And look at that. It ran all the way up. It hit the 618. Gold paused for a little while, which is exactly what you want. And then it goes up and hits that 100% measured move. We'll have its little blow off emotional top where everybody chases it at the end of a move. And then it wipes out and resets. And this happens over and over and over again. And so your bull flag here that you just said, Daryl, is exactly that. It is pointing to 4,100. Whether you use Fibonacci or you just use bull flag analysis, it pretty much comes to the same price going forward. And you got to be bullish on gold here at this point.
Yeah, got it. So looking at silver, silver's been, it broke out of a, it recently broke out, and just wondering what direction are you seeing there on the charts?
Yeah, I'm not a huge fan of silver, is just because it's really volatile. Just if you look at this chart, it's noisy. It's all over the place. It hits higher highs and then it hits lower lows. It's a very noisy chart, but overall, in a grand scheme of things, it's channeling higher. It's in an uptrend. It's just a really sloppy one. So higher lows and higher highs is the definition of an uptrend. I'm not a huge fan of silver. I like gold because it's a very clean chart. I like gold miners as the best opportunity play. I think silver is still bullish. I think silver is going to push higher. I think it could go to about $40.80. It might want to go higher than that. That's kind of where a short-term target is pointing to. And silver miners, they have opportunity as well. I usually stick to the more conservative and the more consistently winning trades. In gold, in large cap gold miners, I win. The analysis and the trade setups I have win a much higher percentage of trades, and I like to win more than I lose. And then on top of it, the trades carry less risk. So the silver space is great. It's for a different animal. It's tougher to trade. You have to put up with a lot of noise and take a lot more risk, and a lot of patterns that fake you out and break out and reverse on you that can shake you out of a lot of trades. You might have the trend right, but you might have to take the trade 2 or 3 times because you get in and then it shakes you out and you get back in. And those shakeouts cost you a lot of money because you keep taking these losses and it rolls over and then you get back in again. So that's the problem with silver that I see. And I pretty much avoid silver until we start like a new super cycle in gold and silver, which if we go into this financial reset over the next year, whenever it's going to happen, when we come out of that, then gold, silver, and miners, all of them will be like game on, and they're explosive. That's when it's life-changing moves usually in the precious metals space, especially in the miners and silver. But right now, we're in a major topping phase, and gold and silver and miners might have a squeeze up short term before selling off. I'd rather go with the more consistent play than swing for the fences with silver, just because you can strike out a lot.
Yeah, definitely. I remember in April when it fell from 35 to about 28, I did go in buying when it fell down significantly, that huge move downward. And then I was surprised when it bounced back, stronger, because usually when silver falls that much, you're in the ditch for a little while.
Yeah, long term, I think those are good opportunities. Those big waves of selling, they're good, but it's just a lot of noise, right? It depends on your personality type, your account size, your style, how active you are. So everybody has their own sweet spot and their own favorite assets and their volatility, their risk levels. So it's there's nothing wrong with silver. It just doesn't fit my criteria. I know people only trade silver, just like I only used to trade the Dow Jones. I used to only day trade the Dow. I did that for years. So everybody finds their sweet spot, and they change over time as they find something better, or their lifestyle or whatever changes for how much time they want to spend on something.
It's a risk appetite too. So when we think about, actually, could we look at copper?
Yeah. Copper, man, it got hit very, very hard. This is something I talked about right back over here. We had this huge move up, and it kept hitting some higher highs over the past about 2 weeks ago or 3 weeks ago. It was hitting some higher highs, and everybody seems to got attracted to it. I went from never really hearing about copper very often to multiple emails a day. What do you think of copper? Let's talk about copper. And let's just zoom out on the big picture here for a minute. You know, this is something we were talking about, or I shared in a mentoring session with investors. We have all these highs. Let me just move this line up a little bit. We have these highs. Whenever this upper end of this range gets hit, we have a big sell-off. Sometimes it's a multi-year sell-off. And of course, we had a news-driven event that blew it right through that level. I think it was based around tariffs and all that stuff. Of course, as you and I just mentioned, a news-driven move, you cannot trust it. The thing is, when it breaks out to all-time highs, this is just typical media and typical traders. It's headline news every day, and then everybody talks about who are in it, who are making money. They talk about their position and how much they're up and how much they're making, and it gives everybody FOMO. And so then everybody else piles in, and then of course the market will eventually reset and collapse on that news-driven move, and that's pretty much what happened. And I was saying, don't touch stuff like this, and unless you've got money that you just want to gamble with and just flip a coin toss. This stuff is super dangerous, and you know it's caused a lot of damage. I know a lot of people who got into it up here. They got into copper miners, stocks as well, like the COPEX. And of course, then it moves down. These things just they're very dangerous. The chart pattern was saying, you know, this is not trustworthy breakout. Yet, unfortunately, people get sucked in and they get FOMO. I actually just wrote an article on wolfstreet.com that talks about FOMO and how it affects you and why it's so powerful and why it's so painful. Why it's more painful to miss out and hear and see other people making or supposedly making money and you're not in it than it is to actually just take the loss. There's all kinds of studies that show that. And that's what the market is great at doing, constantly giving you FOMO. And you're usually going to be left behind and not in a lot of these trades if you don't have a strategy to identify them and to also know which ones to ignore. I could care less what copper does. I could care less if it keeps taking off. I don't want to get involved in something that carries a ton of risk and that is headline news driven because it's like you're walking through a landmine. And I don't want to do that with my portfolio.
Yeah, got it. Yeah, that totally makes sense. The macro, you know, bigger picture with the amount of investment, data centers, and you know, the population growth and things of that nature, like sounds very bullish for copper. But obviously, when folks are, you know, you get news about tariffs and people just pile in and they see, oh, I'm going to miss out, right? Fear of missing out. And people do they can get hurt by that, you know, because this isn't a sustainable move. Like these oftentimes these markets that require a lot of mining, a lot of infrastructure, a lot of investment, capex, and things of that nature. They don't just move like that and then sustain it. You know, it's usually a grind upwards over time.
Yeah, if you look at building construction spending. I mean, it has dropped for housing, it has dropped for like commercial properties. The spending all right now in construction is in power plants, and database centers, just as you mentioned. And that it is super bullish. Like the world is going totally digital, totally AI. Everything has AI. It's embedded in everything now, whether it works well or not. I still think we're in the very early stages of it actually being, you know, good for a lot of things, but it is coming, and that's where the money is flowing. And copper, obviously huge for power transfer, is one of the most efficient metals that's somewhat affordable. Obviously, silver and gold are better, but that you can't go running silver and gold around the world to connect everything. But yeah.
Yeah, And then could we look at the dollar as we get ready to cap off?
Sure. So yeah, the dollar index, obviously it had a very strong rally, and then we had all kinds of stuff, obviously with the new president, all the tariffs talk, and of course it got completely wiped out. And now it's trying to form a bottom. It's trying to create an impulse move, which I believe it has. We'll just have to see how this unfolds. So an impulse move, Daryl, is when the price of something breaks through two previous highs. So we have a previous high right here. We have another previous high right back over here. And so when you have a rally up and it can bust through one ceiling of resistance, a second ceiling of resistance, and keep on going, that means that trend actually has some momentum. It's like if you're in an apartment building and you jump really hard and you hit your head on the first ceiling, you're going to fall back down to the ground. Well, if you jump really hard and bust through the ceiling above you and the next floor's, roof that's above that, obviously you have some serious momentum. And so the dollar has had that. It just broke through that, and now it's fading back and trying to settle down for potentially another push higher and potentially a new uptrend. So that's where we need to just kind of see. And the momentum for the dollar, when we look at it, I mean, a lot of people won't agree with me. Anytime I talk bullish on the dollar, it's nothing but crazy feedback. But the downward momentum, I believe, is slowly turning. And, you could draw a line kind of through these highs or even through these highs through here. We're going to see the dollar try and build out this base and then eventually start to go higher. I think that's the plan. And if it does go higher, it's going to put pressure on metals. But we can see the dollar and gold move up together at times. It's happened many times in the past. So it might slow it down a bit. They might actually rally together. We'll just have to see. And they can do that very easily, believe it or not. But I do think the dollar is trying to find a bottom. I think it may have found a bottom going forward.
Yeah. And it sounds like, from what I've seen in the charts, whenever there's a big market correction, gold typically falls as people need liquidity. Margins are getting called and all type of stuff. People need liquidity, so they sell gold to get liquid. So the dollar definitely is viewed as a safe haven whenever we have those big moves. And if we're heading in that type of environment, the dollar could move higher.
Yeah, for sure.
Okay, so where are you parking capital right now? Where are you positioned? Are you on the sidelines? Are you accumulating? What are you doing over there at the tech traders, the technical traders?
Yeah, so we moved to cash just really as of you and I are talking just 2 days ago, right up near all-time highs. Our system has told us, hey, something fishy is happening. The markets are pretty weak. Very similar to what we saw back earlier this year. Stock market made an all-time high. It pulled back for 4 days, and our system said, whoa, something totally changed. Money flow, sentiment is told us to get out, allows us to avoid this huge crash. And so we've moved to cash. Now we're about a day or two away potentially from a new trigger, a new trade for subscribers. And that's the really exciting part. But overall, this market right now, we've locked in gains. Our accounts are at all-time highs. We're just sitting on the sidelines in cash, collecting daily interest and dividend payments with BIL. It's just a simple almost like a cash position, like a money market fund. It's a treasury note yield fund. And we're waiting for the next opportunity. And sometimes cash is a position. Most people don't agree with that. They don't want to do that. Everybody believes you need to be in positions to make money. And the reality is sometimes the position to be in is cash. And it's about keeping your money versus gambling it at a time when things are uncertain. Now, if the stock market turns up here and starts to go higher, our strategy will kick us right back in as soon as the criteria from strength and momentum and technicals meet up. And then we just catch the next uptrend, which could be big for all we know. And that's where we're at. We're waiting for the next kind of big money making trade. And right now the key is keep your money, gunpowder dry until that pops up.
Got it. Yeah. Thank you for sharing that. Obviously, people can go over to the technicaltraders.com to connect with you. Anything else you want to share with the audience?
No, I think that's about it. I mean, if you want to learn about the markets and protect your retirement, that's what I do with my newsletter. We don't manage money. We don't do any of that. I manage my own money, and I share my portfolio, my exact trades, my allocations, my targets. And really, no matter what, our strategy just keeps growing our account, whether the markets go up, down, or sideways. We know when to own, when not to own stocks, when to hold bonds or currency. And you really just I ride the coattails of the markets. Subscribers follow my exact trades, and that's pretty much what I do.
Got it. And so just one last question, just when you mentioned that, what are you looking at when you're watching? Oftentimes traders are watching what are the big money? What is the big money doing? Because they typically move the markets significantly one way or the other. So what are you typically watching there?
Yeah, that's a tough one to gauge. Yeah, I mean, I follow about 12 different assets. I follow the money flows in and out of them, depending where money's flowing from one asset class to another. Like, is it going from stocks to gold? Or is it going, maybe in the stock market, maybe it's moving to utilities. Recently, we've seen utilities dramatically outperform the S&P 500 in the past week and a half, 2 weeks, to a ratio that it's big enough that usually means the market is putting in a short-term top. Is it a short-term top, or is it the start of a recession? I don't know. Nobody does, but we get out just in case, and we navigate it. So it's hard to get a gauge of it. I follow all of these things, and when enough of them come together and it looks like big money flows are going defensive to various different asset classes and commodities, then I'm like, okay, there's big money moving to all of these other places. They're slowly getting away from the stock market. Stock market's being lifted up by the Mag 7s, which is really just a couple stocks. And that's how I try to gauge it. You can't just follow something that says, oh, all the institutions are buying this or buying or selling. You kind of have to have a high level view and look at a massive amount of volume flow. But it is the key is to understand what the big money is doing, because they're the ones who create the trends. And so when a new trend starts, we look for the money flow. It could be, if it's huge selling, then we're like, okay, well, there's net institutional selling. We want to make sure we are with their position, meaning we don't hold stocks, we're already out, or we benefit from falling prices through inverse ETFs or whatever it is.
Got it. Yeah. Thank you for sharing that. Well, you all heard it. Be sure to go check out thetechnicaltraders.com. Thank you for watching this interview. Hit the subscribe button. We'd love to have your support as we're continuously pumping out content. Thank you, Chris, for coming back on the show.
Thanks, Sarah. Always a pleasure.